To build wealth or achieve financial independence, many individuals mention investing in the stock market. But what is the stock market and how does it operate? Large quantities of money are traded on a regular basis on the stock market, a worldwide network of exchange. Securities are traded on the stock market, not products or services. A share of a firm is a unit of ownership, and securities are rights to financial assets like that. An individual purchases a minor stake in a firm when they purchase shares of that company. Founders need resources in order to develop a sizable firm. Consider the business like a pie. Little chunks of the pie are cut. These little pieces of the pie represent ownership stakes in the business. Often, businesses sell their shares to obtain money for company expansion and growth. Many accomplish this via an initial public offering or IPO. In other words, the firm becomes public and anybody may purchase shares of it. An IPO is when a corporation starts selling a portion of its shares to public investors. A corporation requires a marketplace to do business in order to make it easier for the public to exchange shares, and this is where the stock market comes into play. Worldwide, stocks are exchanged on a large number of stock exchanges. In the US, there are a few more exchanges besides the New York Stock Exchange and the NASDAQ in New York City, the TSX in Canada, the NSE in India, and the JPX in Japan. They establish a worldwide exchange system that enables the trading of shares anywhere in the globe. This enables businesses to raise money to fund their ongoing development and growth. For instance, in its first public offering, Facebook sold over 421 million shares for $38 each. Due to this, Facebook received over $16 billion from investors. Normally, the value of a company's stock reflects how well it's doing financially. Each piece of the pie increases in value as the firm does. For investors, this implies that their initial investment will increase in value as the firm succeeds, which is fantastic. But there are instances where the pie becomes so large that the individual pieces also grow large and costly. At these times, stock splits take place. For instance, if you purchase 10 Apple shares immediately upon the company's IPO in 1980, you now hold 560 shares without making any more purchases. This occurs when a firm becomes too large and its individual shares become too costly for the typical investor to purchase. Consider the scenario where 100 shares were issued when your firm went public. 50 of these shares were sold as a part of your first public offering at a price of $100 each. But since then, your business has expanded greatly, increasing the value of each share to $500. Since the typical investor can no longer afford to purchase your stock, you split your shares 2 for 1, making it simpler for the general public to purchase your stock. The total number of shares in your organization has increased from 100 to 200. By splitting shares, you also divide the original share's value in half. For example, a $500 share would become 2 shares for $250 each. This makes it more appealing for investors to purchase your stock and keep making investments in your business. And it also implies that investors who originally purchased 10 shares of your firm now possesses 20. The value of their original investment has not changed. For instance, on December 12, 1980, Apple had its first public offering and sold its shares for $22. In 1987, when the stock price reached $79 per share, Apple had its first 2-to-1 split, which resulted in a share price decrease to $39.50. In other words, If you purchased 10 shares of Apple immediately after the IPO, you now own 20 shares of the company. In the year 2000, while stock was selling for $111 a share, they underwent their second 2-to-1 split. This implies that the 10 shares you originally had have been converted into 40 shares, each of which is now worth $5.50. In 2005, while the stock was trading at $90 per share, Apple underwent a third 2-to-1 split, bringing the share price down to $45 per share. This means that your original 10 shares are now 80 shares, each worth $45. Also, in 2014, when the price of an Apple share reached $656, the company performed a 7-to-1 stock split, dividing the initial 10 shares into 560 shares valued 93 cents and $71 each. The first 10 shares you purchased for $220 are now worth $183.120, or $327 per share. As of February 2020, this makes the value of the original 10 shares you purchased for $220, or 10 shares. Each initial share of Apple that was sold for $22 in 1980 would be worth around $18,312 now if the company had not divided its shares. Notwithstanding real business success, a firm's stock value might drop due to unfavorable rumors about it. Stock prices don't always represent the status of the company. It might also be the case that many investors would purchase stock in a firm if they believe that a concept has a lot of promise. Young enterprises may obtain funding for their operations even if they are already losing money, which is fantastic for startups. This is best shown by Snapchat, a social media company that raised over $3 billion in its initial public offering, despite not being profitable prior to going public. In the best case scenario, businesses may utilize this money to turn their ideas into reality and start generating money. In the worst case situation, they run out of cash before they can start producing money, which might result in investors losing their money. In a financial bubble, when the stock price is substantially greater than the actual value of the firm, companies might be worth billions of dollars on paper owing to speculation. This can cause you to lose part of all your investments. In 2001, when a lot of online businesses were first being started, this occurred in the US. As the internet was a new phenomenon, many investors invested money in startup businesses. When this didn't occur, many investors sold their stock, bursting the bubble and precipitating the 2001 economic crisis. Many investors purchased shares at a premium price anticipating a rise in the value of the company. Due to the fact that share prices are now impacted by a wide range of variables, including investor demand and supply for the company's shares, as well as the company's reputation. This causes daily variations in share prices. This is one of the arguments in favor of diversifying your portfolio and making long-term investments, according to financial experts. In the past, the stock market has had both expansions and recession, but traditionally, the US market has trended upward over the long run. Please subscribe to our channel and activate the notification bell if you want to learn more about the stock market or investing. Thank you for viewing, and I'll see you in the next video, as usual.